Hey there, finance enthusiasts and curious minds. Welcome back to the channel. I'm thrilled to have you here today for what's going to be an eye-opening journey into the world of banking. Whether you're a seasoned investor, a curious beginner, or someone who's always wondered what really goes on behind those imposing bank facades, this video is for you. Today we're diving deep into the banking system, a world that affects all of us, even if we don't think about it every day. Buckle up because I've got 5 shocking facts that will make you rethink everything you thought you knew about your money. Trust me, by the end of this video, you'll never look at your bank account the same way again. Grab your snacks and settle in because this isn't your average banking lesson. We're about to peel back the curtain on some of the most mind-blowing aspects of the financial world. Are you ready? Let's dive in. Fact 1. All right, let's kick things off with a stat that's going to blow your mind. Did you know that about 90% of the money in circulation isn't even physical cash? That's right, folks. It's all digital. Now, you might be thinking, wait a minute, how is that possible? Well, let me introduce you to the concept of fractional reserve banking. This is a system where banks create money out of thin air through loans and credits. Here's how it works. When you deposit $100 in your bank account, the bank doesn't just sit on that money. Instead, they keep a small portion of it in reserve, usually around 10%, and lend out the rest. Now, here's where it gets interesting. When they lend out that $90, it doesn't disappear from your account. You still have $100 on your balance sheet, but now there's an additional $90 in the economy. This process continues as that $90 gets deposited in another account, lent out again, and so on. It's like a magic trick, but instead of pulling rabbits out of hats, banks are creating money out of thin air. So every time you swipe your card or make an online purchase, chances are you're using money that was never printed. It's just a series of digital transactions moving from one account to another. This system has its pros and cons. On one hand, it allows for economic growth by increasing the money supply and facilitating loans for businesses and individuals. On the other hand, it can lead to inflation if not properly managed, and it's one of the reasons why bank runs can be so catastrophic. Mind blown, right? But hold on to your hats because we're just getting started. Fact 2. Now, let's dig a little deeper into this fractional reserve system we just talked about. Remember how I mentioned that banks only keep a small portion of your deposits in reserve? Well, it gets even crazier. The average bank only keeps about 10% of your deposits in reserve. That means 90% of your hard-earned cash is being loaned out or invested elsewhere. So when you put your money in the bank, it's likely funding someone else's mortgage, business loan, or even shopping spree. Talk about trust issues. This practice is perfectly legal and is, in fact, the foundation of our modern banking system. But it does raise some interesting questions, doesn't it? For instance, what happens if everyone decides to withdraw their money at once? This scenario, known as a bank run, is every banker's worst nightmare. During a bank run, the bank simply doesn't have enough cash on hand to meet all withdrawal requests. This is why, during times of financial panic, you might see images of long lines outside banks as people rush to withdraw their savings. To protect against this, most countries have deposit insurance. In the United States, for example, the Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per depositor, per bank. This insurance helps maintain public confidence in the banking system. But here's a mind-bending thought. If everyone tried to withdraw their money at once, there simply wouldn't be enough physical cash to go around. The entire system relies on the assumption that most people won't need all their money at the same time. So next time you're at the ATM, remember, you're not just withdrawing your money, you're participating in a complex financial dance that's been choreographed over centuries. It's a system built on trust, mathematics, and just a tiny bit of magic. Fact 3. All right, finance nerds, this one's for you. Let's talk about how interconnected our banking system really is. Spoiler alert, it's more tangled than your old pair of earbuds. Here's a fun fact that might keep you up at night. If one major bank fails, it could cause a domino effect that puts your savings at risk. I'm talking about a 2008-style financial crisis. That's why they say some banks are too big to fail. Let me break this down for you. Banks don't operate in isolation. They're constantly lending to and borrowing from each other through what's called the interbank lending market. This market helps banks manage their liquidity and meet regulatory requirements. But here's the catch. This interconnectedness also means that problems at one bank can quickly spread to others. If a major bank fails, it might default on its obligations to other banks, causing a chain reaction of financial distress. Remember the 2008 financial crisis? That's exactly what happened. The collapse of Lehman Brothers, a major investment bank, sent shockwaves through the entire global financial system. Banks stopped lending to each other, credit markets froze, and suddenly, even healthy banks found themselves in trouble. This interconnectedness is why regulators pay special attention to what they call systemically important financial institutions, or SIFIs. These are banks that are so large and so interconnected that their failure could threaten the stability of the entire financial system. It's a bit like a high-stakes game of Jenga. Pull out the wrong block and the whole tower comes crashing down. Except in this case, the tower is the global economy, and the blocks are trillion-dollar financial institutions. So next time you hear about regulations on big banks or debates about breaking them up, remember, it's not just about the banks themselves. It's about protecting the entire financial ecosystem that we all rely on. And yet, despite all this complexity and interconnectedness, I still feel like my local bank doesn't even know my name. Go figure fact 4. Now, let's switch gears and talk about something that's probably sitting in your wallet right now. Credit cards. These little pieces of plastic are more powerful than you might think, and not always in ways that benefit you. Did you know that by merely having a credit card, your credit score could be affected up to 30%? Yep, they're monitoring your spending habits like a hawk. It's not just about whether you pay your bills on time, though that's important too. The credit bureaus are looking at things like how much of your available credit you're using, how long you've had your accounts, and even how many credit cards you have. This is all part of what's called your credit utilization ratio, and it's a big factor in determining your credit score. Use too much of your available credit, and your score could take a hit. But use too little, and you might not be building your credit history effectively. It's a delicate balance, and the banks are counting on you not knowing the rules of the game.